I need to tell you something that's going to sound absolutely insane. But stick with me, because what I'm about to show you is backed by data that even the mainstream financial press can't ignore anymore. There's a 72-hour window happening right now. And I'm not being dramatic when I say that what you do in the next 3 days could determine whether you preserve your wealth or watch it evaporate over the next 12 months. Let me explain what's actually happening behind the scenes. Right now, as I'm recording this, there's a massive structural shift taking place in the gold market that most retail investors have absolutely no idea about. And the people who do know about it, they're moving fast. Very fast. Here's what I mean. In the last quarter alone, central banks purchased over 333 tons of gold. That's the highest quarterly purchase in over a decade. But here's the part that should make your ears perk up. They're not slowing down. They're accelerating. Now you might be thinking, okay, central banks buy gold all the time. What's the big deal? And that's a fair question. But what's different this time is the urgency. These aren't routine purchases spread out over months. These are massive, concentrated buying sprees happening in compressed time frames. Let me paint you a picture of what this looks like on the ground. The People's Bank of China just reported their 18th consecutive month of gold purchases. But here's what's interesting. Their official numbers show they added about 225 tons to their reserves. Sounds like a lot, right? Well, independent analysts looking at import data and refinery flows estimate the actual number is closer to 900 tons. That's 4 times what they're officially reporting. Why would they underreport? Because they don't want to spook the market before they're finished accumulating. Think about that for a second. They're buying so much gold that they have to hide the real numbers to avoid driving the price up before they're done loading up. And it's not just China. Poland just announced they're increasing their gold reserves by 100 tons. Turkey has been buying at a pace that would have seemed impossible 5 years ago. India's central bank is accumulating. Even countries you wouldn't expect, like Singapore and the Philippines, are suddenly becoming major gold buyers. But here's where it gets really interesting. And this is the part that should make you sit up and pay attention. There's a specific reason why this 72-hour window matters, and it has to do with something called the COMEX delivery cycle. Now, I know that sounds technical, but stay with me because this is crucial. The COMEX is where gold futures contracts are traded, and every month there's a delivery period where people who hold these contracts can either roll them over to the next month or take physical delivery of the actual metal. We're right in the middle of one of these delivery periods right now. And something unprecedented is happening. The number of contracts standing for delivery, meaning people who want the actual physical gold instead of just paper promises, is at levels we haven't seen in years. Here's why that matters. The COMEX operates on what's called a fractional reserve system. For every ounce of physical gold in their vaults, there are multiple paper claims on that same ounce. It's kind of like how banks don't actually keep all your deposits in cash in the vault. They lend most of it out, betting that not everyone will want their money at the same time. Well, right now, more people are asking for their gold at the same time than the system was designed to handle. Let me give you some specific numbers to show you what I'm talking about. The registered gold in COMEX vaults, that's the gold that's actually available for delivery, is sitting at around 23 million ounces. Sounds like a lot, right? But there are over 500,000 open contracts. Each contract represents 100 ounces. Do the math on that. That's 50 million ounces worth of claims on 23 million ounces of available gold. Now, normally, most of those contracts get rolled over or cash settled. People don't actually take delivery. But this month, the delivery requests are running at about 3 times the normal rate. And if that trend continues, we're looking at a potential situation where there literally isn't enough physical gold to satisfy all the delivery requests. What happens then? Well, historically, when you get a supply squeeze like this, prices don't just go up gradually. They spike, hard and fast. Let me tell you a story that illustrates exactly what I'm talking about. Back in 1980, there was a situation with silver that became known as the Hunt brothers squeeze. These 2 brothers, Nelson and William Hunt, started accumulating massive amounts of physical silver. They weren't just buying paper contracts. They were taking delivery of the actual metal and storing it in vaults. As more and more silver got locked up in their vaults, the available supply for everyone else started to shrink. And here's what happened. Silver went from about $6 an ounce to over $50 an ounce in less than a year. That's more than an 8x increase in under 12 months. Now, I'm not saying gold is going to 8x in the next year. But I am saying that when you get a supply squeeze in a precious metals market, the price movements can be violent and sudden. And right now, we're seeing all the early warning signs of exactly that kind of squeeze developing. But there's another layer to this that makes the situation even more urgent, and it has to do with what's happening in the physical gold market outside of the COMEX. Premiums on physical gold coins and bars have been elevated for months now. When I say premiums, I mean the amount above the spot price that dealers charge for actual physical metal. Normally, you might pay 3 to 5% over spot for a gold coin. Right now, premiums are running anywhere from 8 to 12%, depending on the product and the dealer. That tells you something important. There's a disconnect between the paper price and the physical price. The paper market is saying gold is worth one thing, but people who actually want to hold the metal in their hands are willing to pay significantly more. And here's where the 72-hour window comes in. Several major dealers have told me, off the record, that they're expecting significant delays in restocking after this week. One of them said, and I quote, "If you want guaranteed delivery before the end of the year, you need to order by Thursday." That's not normal. In a healthy market with plenty of supply, dealers don't tell you that you have a 72-hour window to get your order in. They tell you that when they're seeing supply constraints and they're not confident they can get more inventory quickly. Now, let me connect some dots for you because there's a bigger picture here that explains why all of this is happening right now. We're in the middle of what some analysts are calling the Great Monetary Reset. And I know that sounds like conspiracy theory talk, but hear me out, because this is based on observable facts and public statements from central bankers themselves. The dollar's role as the world's reserve currency is being challenged in ways it hasn't been since the Bretton Woods system collapsed in 1971. And that's not my opinion. That's what the data shows. Look at what's happening with international trade settlements. More and more countries are conducting trade in their own currencies instead of dollars. China and Russia have been doing it for years. But now you're seeing countries like Brazil, India, and even Saudi Arabia starting to settle oil trades in currencies other than dollars. Why does that matter for gold? Because when countries move away from the dollar for trade, they need something else to hold as a reserve asset. And historically, when confidence in fiat currencies declines, gold is what central banks turn to. Let me give you a specific example that really drives this home. In 2022, after the US and Europe froze Russia's dollar and euro reserves, something interesting happened. Countries around the world suddenly realized that holding your reserves in another country's currency means that country can freeze your assets if they don't like your policies. So what did they do? They started diversifying into gold. Because gold sitting in your own vault can't be frozen by a foreign government. It's the ultimate neutral reserve asset. And this isn't just happening with countries that are adversarial to the West. Even traditional U.S. allies are increasing their gold holdings. Why? Because they're hedging. They're preparing for a world where the dollar might not be the undisputed king of currencies anymore. Now, here's where this gets personal for you and your wealth. When central banks are buying gold at record pace, when physical supply is getting tight, when premiums are elevated, and when the geopolitical landscape is shifting in ways that favor hard assets over paper currencies, what do you think happens to the price? It goes up. Not might go up, not could go up. It goes up. That's what the historical data shows us every single time these conditions align. But here's the thing that most people miss. The gains don't happen gradually. They happen in spurts. Gold will sit there, doing nothing, frustrating everyone who owns it, and then, seemingly out of nowhere, it'll jump 10, 15, 20% in a matter of weeks. And if you're not already positioned before those moves happen, you miss them. Because by the time the mainstream financial media is talking about gold's big move, the move is already over. Let me tell you about what happened in 2008 to illustrate this point. In the summer of 2008, gold was trading around $900 an ounce. The financial crisis was just starting to unfold. Lehman Brothers collapsed in September, and everyone was panicking about stocks and real estate. But here's what happened with gold. From September 2008 to March 2009, while the stock market was getting absolutely destroyed, gold went from $900 to $1,000. A nice gain, but nothing spectacular. But then from March 2009 to September 2011, gold went from $1,000 to over $1,900. It nearly doubled in less than 3 years. And the people who made the most money weren't the ones who bought at $1,000. They were the ones who bought at $900 before the crisis fully unfolded and held through the volatility. Right now, we're in a similar setup. The signs are all there. Central bank buying at record levels, physical supply getting tight, geopolitical tensions rising, currency debasement accelerating. These are the same conditions that preceded every major gold bull run in history. And here's something else you need to understand about how gold moves in these environments. Gold doesn't just go up because of inflation. That's what most people think. They think gold is an inflation hedge, and that's it. But that's only part of the story. Gold goes up when there's uncertainty about the future value of currencies. It goes up when people lose confidence in the ability of governments to manage their fiscal and monetary policies responsibly. It goes up when the geopolitical order that's been in place for decades starts to crack. And all three of those things are happening right now. Let me talk about the currency debasement piece for a minute, because this is something that directly affects your purchasing power, whether you own gold or not. Since 2020, the money supply in the United States has increased by over 40%. That's not a typo. 40% more dollars were created in just a few years. And that money didn't just disappear. It's out there in the economy, chasing the same amount of goods and services. What does that do? It makes each individual dollar worth less. Your savings, if they're sitting in a bank account earning 0.5% interest, are losing purchasing power every single day. Now, the official inflation numbers say inflation is around 3%. But anyone who actually buys groceries, pays rent, or fills up their gas tank knows that the real number is much higher. Eggs are up 60% from 2 years ago. Rent is up 30% in many markets. Insurance premiums are through the roof. Your dollars are being debased. That's not a political statement. That's just math. And here's the thing about gold in this environment. Gold can't be printed. There's a finite amount of it. And the amount that gets mined each year is relatively small compared to the total above-ground supply. So when currencies are being debased, gold maintains its purchasing power. Let me give you a concrete example of what I mean. In 1971, when Nixon took the U.S. off the gold standard, gold was $35 an ounce. A new car cost about $3,500, so 1 ounce of gold could buy you about 1% of a new car. Today, gold is around $2,600 an ounce. A new car costs about $48,000. So 1 ounce of gold can still buy you about 5% of a new car. Actually, gold has maintained its purchasing power better than that simple example suggests. But here's what happened to the dollar over that same period. In 1971, $35 could buy you a week's worth of groceries for a family. Today, $35 might get you a couple of meals. The dollar lost over 85% of its purchasing power. Gold didn't. That's the point. Gold is a store of value that maintains its purchasing power over long periods of time, even as currencies get debased. Now, I want to address something that I know some of you are thinking. You're thinking, okay, but gold doesn't pay dividends. It doesn't generate cash flow. Why would I put my money in something that just sits there? And that's a fair question. But here's the answer. Gold is not an investment. It's insurance. You don't buy insurance expecting it to generate income. You buy insurance to protect against catastrophic loss. And in a world where currencies are being debased, where geopolitical tensions are rising, where the financial system is more leveraged than it's ever been, gold is insurance against the catastrophic loss of purchasing power. Quick aside here, because this is relevant if you're thinking about how to actually position yourself in gold. If you're sitting on $100,000 or more in retirement accounts, there's a way to get physical gold into those accounts without triggering taxes or penalties. It's called a gold IRA. I put together a free guide that walks through exactly how it works, what the rules are, and how to set one up. It's in the description below. Worth checking out if you're in that situation and you want to protect your retirement savings with physical gold. All right, back to what's happening in the market right now and why this 72-hour window matters. There's another piece of this puzzle that I haven't talked about yet, and it has to do with what's happening in the mining sector. Gold mining companies are not increasing production. In fact, production has been relatively flat for the last few years, and there's a good reason for that. It's getting harder and more expensive to find and extract gold. The easy gold has already been mined. The gold that's left is deeper underground, in more remote locations, and requires more energy and capital to extract. And with energy costs rising, labor costs rising, and environmental regulations getting stricter, the all-in cost of producing an ounce of gold has been steadily increasing. Right now, the average all-in sustaining cost for gold miners is around $1,300 to $1,400 an ounce. That means at current prices around $2,600, miners are making good margins. But here's the thing. Those margins aren't leading to a big increase in production. Why not? because it takes years to bring a new mine online. You have to find the deposit, get permits, build the infrastructure, and then start extracting. That process can take 7 to 10 years from discovery to first production. So even if gold prices stay elevated, we're not going to see a flood of new supply hitting the market anytime soon. And that means the supply-demand dynamics that are creating this squeeze are likely to persist. Now let me tell you about something that's happening in the ETF market that adds another layer to this story. Gold ETFs, the funds that hold physical gold and allow investors to get exposure without actually taking delivery, have been seeing interesting flows lately. After a period of outflows in 2022 and early 2023, we're now seeing consistent inflows again. But here's what's interesting. The inflows are coming from institutional investors, not retail. Hedge funds, pension funds, and sovereign wealth funds are adding gold exposure. Retail investors, for the most part, are still sitting on the sidelines. What does that tell you? It tells you that the smart money is positioning before the crowd figures out what's happening. And historically, when institutional money moves into an asset class before retail, that's a sign that a major move is coming. Let me give you another historical parallel that shows you what this looks like. In 2001, gold was trading around $270 an ounce. The tech bubble had just burst, and everyone was licking their wounds from the dot-com crash. Nobody was talking about gold. It was considered a barbarous relic, a useless asset that didn't generate returns. But a few smart investors, guys like John Paulson and David Einhorn, started accumulating gold. Not because it was popular, but because they saw the same things we're seeing now: currency debasement, rising debt levels, and geopolitical instability. What happened next? Gold went from $270 in 2001 to over $1,900 by 2011. That's a 7x return in 10 years. And the people who made the most money were the ones who bought early, when nobody else was paying attention. Right now, we're in a similar setup. Gold has been consolidating for the last couple of years. It's not making headlines. Most retail investors aren't paying attention to it, but the institutional money is quietly accumulating. And when retail finally wakes up and realizes what's happening, when the financial media starts running stories about gold's big move, the easy gains will already be gone. That's why this 72-hour window matters, because right now you can still get positioned before the crowd. You can still buy physical gold at reasonable premiums. You can still get delivery without significant delays, but that window is closing. And once it closes, once the supply squeeze becomes obvious to everyone, once premiums spike and delivery times stretch out to months instead of weeks, it'll be too late to get positioned at favorable prices. Let me talk about another aspect of this that I think is really important, and it has to do with the difference between paper gold and physical gold. When you buy a gold ETF or a gold futures contract, you're buying a claim on gold. You don't actually own the metal. You own a piece of paper that says you're entitled to a certain amount of gold. And in normal times, that's fine. The paper price and the physical price track each other pretty closely. But in times of stress, when everyone wants to convert their paper claims into physical metal, that's when you see the disconnect. We saw this happen in March 2020, at the start of the pandemic. The paper price of gold on the COMEX was trading at one level, but if you actually wanted to buy physical gold coins or bars, you were paying 10, 15, sometimes 20% premiums over the paper price. Why? Because there was a rush to physical, and the dealers couldn't keep up with demand. Mints were shut down. Refineries were operating at reduced capacity, and everyone who had been holding paper gold suddenly wanted the real thing. That's the risk with paper gold. When you really need it, when the system is under stress, you might not be able to convert your paper claim into physical metal at the price you thought you were getting. That's why, if you're serious about using gold as insurance, you need to own the physical metal. Not paper claims, not ETFs. The actual metal in your possession or in a secure vault that you control. Now, I know what some of you are thinking. You're thinking, but storing physical gold is a hassle. I have to worry about security, about insurance, about where to keep it. And yeah, those are valid concerns. But here's the thing. Those hassles are the price you pay for having real, tangible insurance. If it was easy and convenient, everyone would do it. And it wouldn't be as effective as insurance. The whole point of physical gold is that it's outside the financial system. It can't be hacked. It can't be frozen. It can't be debased. And yes, that comes with some logistical challenges. But those challenges are minor compared to the risk of having all your wealth tied up in assets that exist only as digital entries in a database somewhere. Let me tell you about something that happened in Cyprus in 2013 that really drives this point home. Cyprus was in a financial crisis. The banks were insolvent, and the government, in coordination with the EU, decided to do something unprecedented. They confiscated a portion of bank deposits to recapitalize the banks. If you had more than 100,000 euros in a Cypriot bank, you woke up one morning and found that a significant chunk of your money was just gone, taken by the government to bail out the banks. Now you might think, that could never happen here. And maybe you're right. But the point is, it did happen in a developed European country. And it showed that when governments are desperate, when the financial system is under stress, your bank deposits are not as safe as you think they are. But you know what they couldn't confiscate? Physical gold sitting in a private vault or a safe deposit box. Because it's not part of the banking system. It's outside the system, which means it's outside the reach of desperate governments looking for assets to seize. That's the ultimate value of physical gold. It's a form of wealth that you control, that exists outside the financial system, and that can't be confiscated or debased by government decree. Now let's talk about what's likely to happen over the next few months, because I think it's important to understand the trajectory we're on. Based on the current supply-demand dynamics, based on central bank buying patterns, based on the geopolitical situation, and based on historical precedent, here's what I think is likely to unfold. In the short term, over the next few weeks to months, I expect gold to continue grinding higher. We might see some volatility, some pullbacks, but the overall trend is up. The supply squeeze is real, and it's going to take time to resolve. In the medium term, over the next 6 to 12 months, I think we're likely to see gold break out to new all-time highs. We're already close. Gold hit $2,685 earlier this year. A move above $2,700 and then $3,000 is very much in the cards if the current dynamics persist. And in the longer term, over the next few years, I think we could see gold move significantly higher. How much higher? That depends on a lot of factors. But if we see a real loss of confidence in fiat currencies, if we see a major geopolitical event, if we see a financial crisis, gold could easily move to $3,500, $4,000, or even higher. I'm not making those predictions lightly. I'm basing them on historical precedent and on the fundamental drivers that are in place right now. But here's the key point. The biggest gains are going to go to the people who position themselves now, before the move becomes obvious to everyone. Once gold is making headlines, once everyone is talking about it, the easy money will already have been made. That's why this 72-hour window is so critical. Because right now you can still get positioned at reasonable prices. You can still buy physical gold without significant premiums or delays. You can still get in before the crowd. But that window is closing fast. And once it closes, once the supply squeeze becomes undeniable, once premiums spike and delivery times stretch out, it'll be too late to get positioned at favorable prices. Let me leave you with one final thought, because I think this is the most important thing I can tell you. Wealth preservation is not about making the highest returns. It's about making sure that the wealth you've accumulated over your lifetime is still there when you need it. And in a world where currencies are being debased, where governments are running unsustainable deficits, where geopolitical tensions are rising, and where the financial system is more leveraged than ever, the risk of catastrophic loss is real. Gold is not going to make you rich overnight. It's not going to 10x in the next year. But it is going to preserve your purchasing power. It is going to protect you against currency debasement. And it is going to be there, holding its value, when other assets are getting crushed. That's the role of gold in a portfolio. It's insurance. It's protection. It's the asset you hope you never need, but you're glad you have when things go wrong. And right now, with all the signs pointing to increased volatility, increased uncertainty, and increased risk in the financial system, having that insurance is more important than ever. So, here's what I want you to do. Take the next 72 hours seriously. Do your own research. Look at the data I've presented. Think about your own financial situation and your own risk tolerance. And if you decide that having some physical gold as insurance makes sense for you, don't wait, because the window for getting positioned at favorable prices is closing, and once it closes, you'll be paying significantly more for the same protection. The choice is yours, but the clock is ticking, and 72 hours from now, this opportunity might be gone.